We're entering into one of the craziest moments in economic history. Equity indices broke their June lows this week. Comparisons to the great financial crisis in 2008 are becoming more striking, with SPX closing 3 red quarters for the first time since that period. The Fed just ramped up its quantitative tightening efforts. Sovereign debt is becoming a full-blown crisis. OPEC is cutting production to send oil prices vertical. Inflation isn't going anywhere as fast as anyone wants. The euro and pound are diving like soccer players. Yes, it's called soccer now. Putin is talking all kinds of spicy about the war with the West. And the entire UK pension system almost just got margin called. Last but not least, retail investors have yet to truly capitulate despite literally everyone else doing it. This is setting up an absolutely brutal next leg to this bear market and macroeconomic recession. So all of this really begs the question, can you really get a 99.95% discount at Chipotle by paying in Ether? Well, the answer to that might surprise you. It's actually yes, but it's not you like other yous because it already sold out. But shout out to Chipotle for the proof of stake promotion. But for the rest of us, we'll be eating humble pie if we missed that promo. The real question here is what happens next? Is all of this negativity as the Fed is smothering an already battered and bruised economy and mainstream markets, is it going to drag us further down into the bear market, or is something surprising going to happen? Usually when all of this bearishness adds up, it can make way for a pretty incredible rally that shocks, surprises, and destroys the aggressive shorts. So let's dive in on today's video, bounce or die. Yes, super dramatic. If you guys are excited for this video or my return from wedding and honeymoon season, I know it's been an absolute monster amount of time that I haven't been making consistent videos, but you guys had the tools. I gave you my outlook and you guys knew that I was expecting more bearishness, and we've kind of just gone sideways and lower since I've been calling for that. So the reality is that I feel like I equipped the audience well. So if you guys have been enjoying the accurate bearish calls over the last 4 to 5 months, then smash that like button. And of course, in response, here's a picture of an adorable ghost. That's right, it's Halloween spooky season, and this whole market is getting crazy. So smash that like button, make sure to follow, because we're gonna be bringing you the absolute best information and analysis in this space. With that said, let's jump into this. First of all, let's get to the ugliness of the S&P breaking below its prior lows. As you can see, we have the prior lows here that we have shattered below, and that is not a good sign. And this is as we're hearing rumors that Credit Suisse and another major bank are potentially facing an existential crisis. Again, this is smelling of 2008, of the great financial crisis, of banks collapsing, of very big issues. I mean, what we really want to know is, are we just going to continue going down here, or was this just kind of a liquidity trap where then we reverse right back up and have this crazy bear market rally? Again, I didn't go to school to learn how to draw arrows on these stock charts, and that's why I suck at it. But the reality is that this is a very big moment. Is this going to be the beginning of the total collapse here of mainstream markets, or are we looking at a fake out to trap more liquidity and then we reverse up? Again, this market is going to be filled with, and drill this in your head, fake outs, absolute scam pumps, scam dumps. It's PvP. You have just the most savage traders left going after stop hunting, and I'll explain a little bit of this at the end. But this is what happens when you clear out sort of normal long-term trend thinkers and you just have instead this very savage, very high-level professional PvP game happening in markets as liquidity dries up. And the thing is that liquidity has actually been holding up a lot better in Bitcoin land. As you can see, the Bitcoin chart is looking way better than what you see on SPX, as we have not yet made new lows from June. That said, it's far from rosy, because this is the first time that we've made 3 negative quarters here since the great financial crisis in 2008. As you can see here, we have the great financial crisis here as the last time that we've repeated this particular pattern. And that means that we could just be at the beginning of a similar drawdown like we saw in 2008. And as you can see, the S&P from 2020 to today pretty much perfectly parodies the actual moves of the 2008 crisis from 2006 to 2008, which means that we might be on course for another major leg down. And this is a lot to do with the Fed reducing its balance sheet. You see, the Fed stepped up their interest rates earlier this year, and that was to increase the cost of money, to smother inflation with one tool. But the second tool is to actually remove money from the market. They were buying stuff, meaning they were putting money into the market nonstop throughout 2020 and 2021. Now they're completely reversing that. They're taking stuff off the market. So it really begs the question, are we going to reverse all the way down to where we were before the great money printing of 2020 and the pandemic fake out? Are we going to go back there, I think that that's a fair target. We'll talk a little bit about that at the end of the episode. But the point is that they're really only just stepping up, removing liquidity. They increased interest rates. Now they're removing liquidity. And the two together is an absolutely spicy combo for markets. And as Robert Smith of Financial Times reports here, jaw-dropping quotes on how close we just came to catastrophe today, senior banker describing the leveraged unwind in gilts as coming close to triggering a Lehman moment, asset manager accusing the Bank of England of ignoring calls to intervene sooner. Effectively, the moves by Bank of England are triggering a potential margin call on pensions in the UK, which without explaining this entire situation in depth, which I can do on another video, and I will do most likely, is that grandma's retirement fund and pension fund almost just got completely liquidated. Repeat after me. This is not great. What we just found out is that the Bank of England is activating yield curve control, effectively turning back on the money printers to buy the bonds to control interest rates so that everything doesn't slip out of whack. And that, my friends, is the beginning of a pivot, at least from Bank of England, on this whole charge against inflation. Now, we haven't seen a blink like this at the Fed yet, but these are the types of things breaking that we've discussed now for months, because these are the things that when they break will force the Fed and other banks to jump in and save the day with a bunch of money printing. Now, when that happens, it inverts this entire dynamic on its head, and risk assets will once again become the fastest horses to get out of the dollar. But again, let's talk about this at the end of the episode because there is so much going on, and it's not so simple as this on-off switch of generational wealth being created. But as you can see, Bank of England is already having their problems, and that is a major crack in this macroeconomic push to strengthen cash. Meanwhile, we still have the energy crisis growing and growing, with OPEC deciding that they're going to collectively cut their production by over 1 million barrels per day. This as German officials are warning that there will be significant shortages during the winter, when energy is most needed to heat households. And this is, of course, as the Nord Stream pipeline, the pipeline between Russia and Germany, got effectively sabotaged. And the official opinion is that it was Russia. However, there is this clip of Biden saying that if things stepped out of hand with Russia, that they would blow up the Nord Stream pipeline back in February.
If Russia invades, there will be no longer a Nord Stream 2. We will bring an end to it.
Again, I'm not an expert. I don't have any clue, but I'm just saying that this is a huge amount of pressure on the energy supply flowing into Europe. It is an inordinate amount of pressure coming in, and that will affect prices, inflation, and it will, again, make things even harder for the central banks. But if all of that was not enough, let me assure you that there is more, and that is as Putin steps up his anti-West rhetoric in a speech that many experts are calling historic in its nature of aggression and anti-Western sentiment. Does this mean that we are on the brink of a much bigger escalation of the current war in the Ukraine? Is this part of Russia's plan? Did Putin anticipate any of this? Is all of this coming to a head? And what does it mean for our markets and our bags and our world as it exists today? And the Chipotle discount, what does it mean for the Chipotle discount? We're going to talk about all those things in a minute. But first, let's talk about something a little bit more positive, which is a short-term bit of relief. You see, almost all markets, crypto and otherwise, are at generational support levels. Usually, this triggers a technical rally, meaning that when things are too far sold, they bounce back. And this is as we're starting to see handouts once again make their way out into the public, which of course could trigger a bit of short-term relief, even though it extends the pain. The reality is that a rally right now would be super unhealthy for markets, and it would ultimately extend the situation. But expect the unexpected is the number one rule right now, and almost everybody is jumping on the bear train. I don't think I've seen sentiment this negative throughout this entire bear market as it is right now, as the amount of negative news from all sides is just piling up and piling up. And that is precisely when you get the unexpected pumps, the unexpected moves upward that cause the maximum amount of pain. We'll talk about max pain and PvP again at the end of the episode, but short-term relief rallies are possible. And in fact, a short-term relief rally has been called out as a possibility by Darius Dale and Wifey Alpha, two amazing macro sources that we've been relying on throughout the entirety of this bear market. Again, my goal here is not to call short-term trends. In fact, I'm not advocating that anyone mess with the short-term trend, because that is not an easy game to play. The goal here is to hang out, to bide our time, to preserve our capital, to make as much money as possible, and to invest when the tides truly turn and a bottom is formed. But with that said, signs pointing to a short-term relief rally are definitely possible. And remember when I said something about the Fed blinking? Well, they're apparently getting less concerned about inflation than they are about, quote, financial stability. As Charles Gasparino says, Fed officials getting increasingly worried about, quote, financial stability as opposed to inflation as higher rates begin to crush bonds. Several big investors tell, Charles, Fed growing worried about possible, quote, Lehman moment. This is, of course, a reference to Lehman Brothers, who collapsed in the 2008 Great Financial Crisis, with a 4% federal fund rate as bonds and derivatives tied to them crash. Given the enormous debt issued in the past 3 years at super low rates. A Fed watcher told the UK intervention was not a one-off, and that the same systemic risk could happen here, which might cause the Fed to pause. More later on Fox Business. The point there is that when a ton of debt rushes into the system, money's free. People are making a ton of money by borrowing and reinvesting in real estate, in stocks, and crypto. Effectively, the point of the government's policy was to push money out there and to stimulate the economy, and it worked. And now they have so much debt in the system that raising the cost of that debt could potentially break things. And so that might cause the Fed to pause, step in, and turn the money printers back on, which of course would be disastrous for inflation. So what does it all mean, and where are we going? Well, if you enjoyed this episode, take a minute and destroy that like button. Seriously, here's a picture of an adorable puppy in a Halloween costume. What a reward. Smash the like button, learn something, and of course, make sure you subscribe. So let's wrap this thing up, because there was a lot that we covered. Most importantly, the world's financial markets are sitting at support right now, which usually means a little rally is possible. There's way too much bearish sentiment, and I haven't been trading on sentiment for a while now because most people are not respecting the macro situation. And while I do believe that the macro situation will deliver more blows eventually, it feels as though there is just this over bearishness that is just perpetuating. So I would not be surprised if I saw a rally. Now, does this mean that I'm going to be spending a lot of money effectively longing everything for this rally? Hell no, that is not my plan. My plan is to remain patient, to stick to my guns, and to be prepared to layer in buys at the generational lows that are coming up. More importantly, this has become a PvP market. It's all about doing the unexpected, predicting reactions to events that haven't happened yet, and so people are reacting to the reactions of It just feels like this really hard game to predict. It's not one that I have that much interest in playing. The reality is, however, that DCA is something that should be talked about now, and it's something that I'm going to start doing very soon, because the reality is that there's a real chance that something breaks, the Fed turns back on QE in the not too distant future, because financial stability is now becoming the thing that they're talking about, which requires them to do what they always do, which is to spend money. And of course, as they print more money to solve the problems, that should be absolute wings for risk assets like cryptos, tech stocks, and real estate that have gotten beat to smithereens over the last few months. You can't do both. You can't save the market and the market prices as well as fight inflation at the extent that inflation is coming in at. It's going to start to be a pick your poison type of situation, and I believe that the government will let inflation run hot a little bit longer instead of letting the whole banking system or bond system collapse. That's just not going to be what they're going to do. So to reiterate, expect the unexpected. I'm beginning to DCA soon, regardless of the fact that I think lower prices are coming. My DCA is set for years out, so I'm not just trying to buy it all right now. I'm trying to space out my buys over a long period of time. And remember that these types of markets that drain liquidity favor true innovation, true builders, and true products. And the products within crypto over the next year to 2 years that gain users, that make real revenue, and that continue to proliferate through difficult conditions are the ones you want to be paying attention to. And in a world where all of the easy noise is reduced, those projects will emerge victorious. And I'm so excited to cover what I think of as what has clearly become the most difficult, but also one of the most important moments in crypto history. As always, if you guys enjoyed this, smash that like button, subscribe for more, and I'll be back with many more videos this week, this month, and beyond, as I am back, and it's so good to be here. I thank you very much for watching, and I'll see you soon on the next episode.